Patrick, so why do we have the downgrade and why do we have it now?
Well, nice to see you. I think the timing reflects the fact that rating agencies are looking out for bond investors. So we have very long time horizons in mind, sort of 5 to 7 years if we possibly can do. And the issue that we're highlighting is exactly the same as the Senate Economics Committee highlighted in its report last week, which is that the structure of the Australian financial system diverts savings into superannuation, and those savings don't really find their way into the banking system. And equally, while the banks have been working very hard to reduce their sensitivity to wholesale funding conditions, we just feel that going forward it's going to be very difficult for them not to have to rely on these markets again when growth starts to pick up and credit demand picks up.
Patrick, is it the case that it's the debt market that has changed rather than the banks themselves?
Well, I think you've hit the nail on the head. If we have to think about, what's changed, this was an issue that we were highlighting for a number of years pre-crisis as the biggest risk to Australian bank ratings. Then, of course, during the crisis period, we had the government and the central bank making changes to support banks with some extraordinary measures. And as those measures are now running off, we have to start thinking about the longer-term fundamentals. Clearly, the next 5 to 7 years, we're going to have debt markets that are a lot less liquid and a lot more volatile than we had in the 5 to 7 years running up to the crisis, and we feel we have to reflect that in ratings. The other thing that's changed is the nature of the Australian economy. There's a lot more concentration now on the resources sector, and that is at a policy levels causing lots of concerns. And therefore, if you have big economic concentrations and at the same time high asset prices, you obviously have a sensitivity to external shocks or even just confidence shocks, and that will flow through to the banking system.
Let's also just look at the example that we have from history. Northern Rock in the UK was principally went under because of its exposure to the wholesale market. Has that been a salutary lesson for you in terms of watching what goes on in that particular debt stream?
Well, I think that's a fair comment. All markets globally assumed that liquidity would be available for the banking sector. And I suppose if there was, one big surprise out of the crisis, it's that secured markets, in particular securitization, were the ones that actually closed first, not unsecured markets. And I think that's led a lot of people to rethink their view of risk.
Okay, with the way that Australian banks are, well, they own many of the New Zealand banks, are you going to be looking at New Zealand's banks next?
Yes, we've already said that New Zealand banks are on review. Part of the decision on New Zealand bank ratings will be the view as to how much support the parents can provide at the lower rating for the parents. But there are also issues unique to the New Zealand banks. Obviously, the economy has recovered a lot slower, and now we've had the impact of 2 earthquakes. In addition, these kinds of funding issues that we've thought about at the banks are equally present in New Zealand. It's an economy that's very dependent on foreign funding. And then the final part of the mix is that the central bank has made a proposal that would make it easier for them to implement their own bank resolution scheme that's been in place for a number of years. That's part of a broader trend we're seeing, governments trying to stand back from supporting banks in future. And that obviously will have to make us think very hard about how much government support we build into those New Zealand bank ratings.
Patrick, thank you. Patrick Winsbury there from Moody's Investor Service.